Hi, we're working on Chapter 11, which deals with issuing stock and paying dividends on stock. It's the shareholders' equity portion of the balance sheet. So, it's important to understand these transactions, and we're just going to start out with issuing stock, then we'll move on to dividends, and in the next video we'll just do a whole bunch of entries. Alright, so the first thing we're going to do is practice exercise 11-2A from the textbook, and we worked this in class as well. And for this exercise, we're issuing some common stock and some preferred stock. So, as you might recall from class, common stock, like it sounds, is kind of your regular, usual stock that gets issued. The owners of common stock typically get to vote. They're the owners of the company. Preferred stock, like the name preferred implies, gets something extra special. And typically what that extra special thing is they have some guaranteed dividends that they get paid before the common shareholders. So typically there's some percentage that a preferred stockholder is going to get, 1%, 2%, something like that, and only then will common stockholders get any dividends. Now in this case we're not really talking about dividends, we're talking about issuing the stock. So when companies issue stock, what they're doing is raising capital, getting money in. So there's going to be some cash coming in from issuing the stock, and we're going to categorize it either as stock, which you're used to seeing on the balance sheet by now, or this other new kind of account called paid in capital excess of par or excess of stated value. So sometimes people pay a little extra for the stock beyond what's stated or beyond the par value, and we need to recognize that in a separate account. That's the thing about accounting, we're always separating things into separate accounts. We're putting things in the right categories. And in this case we need some more categories to be able to track what's the par value of the stock, what's the stated value of the stock, and what's the extra that people paid us. Alright, so let's just jump into practice exercise 11-2A. On May 10, Century Realty issued for cash 90,000 shares, no par common stock. They had a stated value of $30 per share, but they sold those or issued those for $42 per share. So here's this stated value of 30, and they actually issued those and got $42 per share for each share they issued. Okay, then they issued some preferred stock, right? So they issued on December 1st 36,000 shares of preferred at $25 par, right? And $33 on the next issue, right? So let's go ahead and journalize these issuances of stock. All right, nothing to do with dividends yet. We're just going to issue some common stock and we're going to issue some preferred stock. So of course journal entries, I've already got one set up, so we just have accounts, our debits and our credits. So let's do this first journal entry for we got 90,000 shares, stated value of 30, we actually issued them for 42. So we're going to have to do a little bit of math here. We're going to have to figure out how much cash did we get. Of that cash, how much was common stock, the value, the stated value, and how much was excess of stated value. So let's figure out how much cash, because I always like to deal with cash first. So let's just do I'm just going to write down here and do the math, right? So it's saying that we issued 90,000 shares for $42 per share. So the cash, right, is, well, we issued 90,000 times 42, and that equals $3,780,000. $3,780,000 is how much cash we got in. So of that, the stated value the problem tells us is $30. So we need to figure out, of that cash we got in, how much is for the stated value. So that's that same stated value is equal to my 90,000 shares times 30, which is equal to 2,700,000, right? And I should be able to figure that out in my head. 2,700,000. All right. And so the difference between that, between the cash we got in, the 42, and the 2,007,000, that is our excess, right? That's what we got in excess of par. So obviously, math, there's a couple different ways you can do this. You could just do 12, right? The difference between 42 and 30. So excess is equal to 12, right? Times 90,000, right? And so that's equal to 1,080,000. Or you could just subtract, right? You just go 3,780,000 minus 2,700,000 is equal to 1,080,000. And, just however you like to do it, just understand that you need to calculate this excess, right? So you've got your total cash coming in, you've got your stated value, and you've got your excess. So now we're ready to do the journal entries for that, right? So of course, they are telling us that on May 10th, we issued the common stock. So May 10th, right? May 10th, we got cash in, 3,780,000. And of course, cash coming in is always a debit. All right, so where is this stuff going? Well, it's going to be a balance sheet account. It's going to be your stockholders' equity. So increases in stockholders' equity are always credits. So you're going to have two credits that equal that debit. So the first one, right, is common stock. Right? And we already figured out the common stock face value is 2,007,000. So if you were to look on the balance sheet on the owner's stockholders equity side, you'd see common stock 2,700,000. And then we had that capital in excess of stated value, and so that's another separate type of account. Capital in excess stated value, and that's my 1,080,000, right? And there's that transaction. We've issued stock and we got the cash in. We broke it up into common stock and capital in excess of stated value, and our debits equal our credits. So we're done with that part. All right. So the problem goes on to say that on September 3rd, we issued at par value 36,000 shares of preferred stock, 1%. So that doesn't really apply to what we're going to do right now, but just so that you know, that means that their dividends are going to be 1%. And they get that before the common stock people get dividends, if there are dividends. If there's no dividends, nobody gets anything. All right, so 36,000 preferred at $25 par for cash. So they're telling you there is no excess of par. We issued it at par value, and par value is $25. All right, so great. We just need to do our math, and I'll go ahead and do that. So we've got the preferred, right? And so that is telling me it's $25 times 36,000 shares times 25 per share is equal to 36,000 times 25 is $900,000. All right, so that's my cash that's coming in, and that's my preferred stock. There is none of this excess because we sold it for exactly its par value. So that was on September 3rd. All right, we got cash in of 900,000, right? And we issued preferred stock, not common stock, preferred stock of 900,000, right? So that is done because there was none of this excess. It's just at the par value. All right, so if you were to look at the balance sheet, the stockholders' equity portion for this particular organization, now you would see an extra line you're not used to seeing, right? You'd see under stockholders' equity, you see common stock, capital in excess of stated value, and preferred stock. So there's a few more items going on the balance sheet now that we haven't really divided out before. And the last thing for this one, they went ahead and they sold some more, or issued some more, on December 1st, they issued some more preferred stock, right? It still has that same $25 par value. They're still going to pay 1%, but they issued it for $33, so you're going to have a little excess paid in capital on the preferred stock issuance. So it's going to look more like that first transaction, but it's just on preferred stock, which has the par value of 25. So we need to calculate how much cash came in, right? So that would be $25 times, how much did they issue? 14,000. Right, so 25,000 times 14,000. I'm sorry. Par value is what that, so they issued it for 33. So this is important. 33 is the cash, right? They got cash 33 per share times 14,000, and that's 462. Right, 462. Now we're going to do this little step. What's this? We call it par value, not stated value. So par value, we know is 25 times 14,000, and that's equal to 350,000, right? And the excess is equal to, you can either subtract the difference here, right? So you can go 8 times 14,000, or you just subtract the difference here, right? So either way, it's 112,000, right? So, or it could be 8 times 14,000, right? So 100, that's the excess right there. However you like to calculate things, I'll leave that up to you. But this is going to look kind of more like this one because we've got capital in excess. It's in excess of par, and it's preferred stock, all right? So on, let's see here, the date is December 1. Right, we're getting our cash in. We've issued stock, so cash is coming in, 462,000. Right, we have preferred stock issued, and that is our 350,000. Right, and we have capital in excess of, this time it's called par. This stock had a stated value of 30. This has a par value of 25. All right, so that's 112. And your debits equal your credits. So you're done with practice exercise 11-2A. Good job.